part of the Internal Revenue Code. Section 529A of the Code authorizes the creation of a tax-free savings account for those who became severely disabled before the age of 26. The concept is to allow those disabled individuals to save money for their own use without affecting their benefits like SSI or Medicaid. There will not be any tax on the earnings in these accounts, and they should be as easy to set up as any bank account. Now, if you were disabled before the age of 26, you can qualify for the creation of an ABLE account in one of two ways. One, you can establish that you are receiving SSI or SSD. Two, you can get a doctor's certification saying that you meet the medical criteria for receiving SSI or SSD. Now, the money in the ABLE account can be used for what are called qualifying disability expenses, including education and housing, health expenses, transportation, personal support, and so on. Each state needs to set up legislation to participate in the ABLE account. Pennsylvania has introduced legislation to authorize the use of these accounts. Given the rather uncontroversial nature of the legislation, we all anticipate it's going to pass in the relatively near future. Now, there are some less than attractive aspects of the law that make the use of the ABLE accounts inappropriate in certain situations. The first is the age limitation. So if somebody suffers an accident or disability after the age of 26, they're not going to be able to use these accounts. Secondly, there are some funding restrictions. You cannot exceed what they call the federal gift tax exclusion. So that's $14,000 per year right now. And if the value of the account goes over $100,000, it will be considered a resource for the purposes of eligibility for SSI. Surprisingly, it's not going to be considered a resource for Medicaid purposes. And there is a payback provision for these accounts. At the death of the person who created the account, there will be a Medicaid lien on the balance left in the account. So, in some cases, these accounts won't make a lot of sense. If third parties like parents or grandparents want to give money to their disabled child, a fair amount of money, then they need to be advised to set up probably a third-party special needs trust. There's no payback provisions in special needs trusts set up by third parties, and the trust income tax obligation of these trusts is usually inconsequential. ABLE accounts really make sense for those higher functioning, disabled individuals who want to earn a wage and not lose their SSI or Medicaid. They can now save well in excess of that $2,000 limit and keep their benefits and hopefully live a more comfortable and independent life. Captain America.